If you're not splitting out your payroll, your labor metrics are lying to you, I promise. But I've seen it so many times in the moving industry. Most of us look at payroll as one big expense or one big line item, right? Payroll. But while it might be easy from a bookkeeping standpoint, it creates really bad data, and bad data leads to bad decisions. So today, we're gonna walk through why payroll allocation matters, how misallocated payroll distorts our metrics, and why this is one of the most overlooked issues in a moving company financial statement. Payroll is not just a cost, right? It's a signal that tells us how efficient our crews are being, whether our sales team's producing profit, if our overhead is just bloated, and whether ownership is truly being compensated appropriately. When payroll expense is lumped into one account, we lose all of that insight, and we can't manage what we can't measure. In a properly structured set of financials, payroll should be split into distinct functional categories. So we have three main categories that we recommend: direct labor payroll and its payroll tax, sales payroll and its payroll tax, and then administrative and owner payroll and its payroll tax. And each of these plays a different role in the business, and mixing them together hides what's really happening. Direct labor is the cost of doing the move, right? It's what drives gross margin. When we mix sales, admin, or owner wages into this direct labor, or worse, we lump everything together, we end up with labor percentages that look too high or too low just for the wrong reasons. So at that point, we might think that crews are being inefficient, our pricing is maybe wrong, our margins are shrinking, when in reality, it's just that the data itself is flawed. Another major issue that I see pretty often is payroll taxes not being allocated to the payroll costs that it's associated with. Employer payroll taxes, specifically FICA, is 7.65% of wages. So that's an expense that the company pays and never gets back, right? Wages are 7.65% more than what you think they are. And a 7.65% of wages cost isn't just a rounding error, right? It's a sizable cost. It's what we would call a material cost. It's a lot, right? And when payroll taxes aren't allocated alongside the wages that they relate to, direct labor taxes with direct labor, sales payroll with sales payroll taxes, admin and owner payroll with admin and owner taxes, right? We end up underestimating some of those costs or overstating other costs. And that creates really inaccurate comparisons between departments and misleading margins just across the whole board. A common issue is sales payroll being buried inside a general payroll account. Sales payroll should be evaluated independently because it answers a critical question. Is our sales function putting unnecessary burden on our margins? And if we don't isolate sales wages and payroll taxes for sales, we can't tell whether commissions, bonuses, or sales salaries are producing a return proportional to the revenue it's generating, right? We lose visibility into one of the most important growth levers in the business. Now, another aspect about sales payroll that may seem interesting is there's something called GAAP, Generally Accepted Accounting Principles, and GAAP says that sales payroll really should actually be an overhead cost and not a cost of goods sold. But here at ProMover Accounting, we would rather have accurate metrics and accurate break-even analysis than confirm to acceptable principles that really mean nothing for a moving company owner. So that's why we recommend having sales payroll to be included in gross profit versus overhead. Now, owner payroll is one of the most commonly misallocated payroll categories. And not only because it's usually not broken out correctly, but because the amount itself is usually the problem. First off, if owner payroll is mixed into administrative payroll, or worse, direct labor or sales payroll, right? It artificially inflates and skews metrics that are supposed to be reflective of operational efficiencies. And at the same time, if an owner's taking way too much or way too little of a payroll for the role that they're actually performing, it can skew every benchmark that we compare ourselves to. And we end up asking, why don't our margins match the industry? Why does the business feel profitable, but it doesn't show that it's profitable? And often the answer isn't performance, right? It's classification. When payroll isn't split properly, we make decisions off of distorted metrics, which obviously is never good, right? We might feel that we need to raise prices when we actually don't need to. We might feel like we need to cut our labor when labor might actually not be the problem. Or we just hesitate to grow because we're so focused on these wrong problems, right? It may not be a bookkeeping problem. It might actually be a decision quality problem. Payroll allocations aren't about making your financials look fancy, right? They're about making your financials useful. And when payroll and payroll taxes are properly split between direct labor, sales admin, and owner payroll, then we get clarity, right? And this clarity leads to better decision making. That's why we're doing this, right? So if you see the value in this and you want your financials to give you the information that you need to make educated decisions, go to our website, go to promoveraccounting.com, and let's talk. We'll see if we can help. We'll see if we're going to be the right partner for you.